On to our next presentation. This time we have Mr. James Lauer. He is a Director, Industry Economics and Taxation Division of Natural Resources Canada. The title of his presentation is Minerals and Metals in a Changing International Environment, a Canadian Perspective. Mr. Lauer joined the minerals and metals sector of Natural Resources Canada in 1992. Over the years, his responsibilities have focused on promoting domestic and international investment in Canada's mineral and metals industry, reviewing the international competitiveness of Canada's investment climate for mineral capital, and analyzing the importance of the minerals and metals industry to the Canadian economy. Mr. Lauer was promoted to the position of Director Investment in 2006, following an assignment with Environment Canada relating to the development of program and implementation options for greenhouse gas emission reductions. In 2008, with the addition of his responsibilities for exploration and tax policy and administration, Mr. Lauer became the Director, Industry, Economic and Taxation Division. Prior to joining the minerals and metals sector, Mr. Lauer worked for the Department of Foreign Affairs and International Trade. Mr. Lauer obtained a master's degree in international affairs from the Norman Peterson School of International Affairs, Carleton University, Ottawa. Let's welcome Mr. Lauer.
Good afternoon. I guess the only thing worse than presenting at this time today is probably doing the same presentation tomorrow. Having said that, I'll try to make this as dynamic as possible. What I've wanted to do here is try to look at some of the long-term trends. We've done an awful lot of focusing on the recession, managing the recession, and what I'd like to try to do is look at some even longer-term trends that the industry has to be aware of. Some of the earlier speakers noted is that we tend to be looking, say 3 years, maybe 4 years if we're lucky. But these are some, I'm going to try to show you some longer term trends that are happening internationally and within the minerals and metal industry and with particular reference to Canada. So let's focus on some recent developments. This is a fairly complicated slide. But the point here with the chart on the left is just looking at the world's largest economies and how that has changed. When you're looking back 1990, US, Japan, Germany, you don't see Asia ranking in the top 3. Now we're looking at China has moved into second spot. By 2020, it is forecasted that both China and India will be in the top 3, and we are looking at China being the largest economy in the world. If you look at the top 10 by 2020, you can add Brazil and Mexico. So what we're looking at is a definite shift away from the traditional developed world and towards the emerging economies. That is going to have some long-term effects on trade patterns and investment patterns. So now, if you look at the graph to the right, is the influence of foreign investment, foreign direct investment. Investment is growing faster than trade, or for that matter, growth in GDP. So this is another development that we're seeing is investment, i.e. firms are intermixing. You're seeing that physical presence where you go back, say, 20 years ago, and the tendency was to trade with people. Now you invest and you run businesses within those jurisdictions. So again, a definite change. And this flow with respect to investment is very, very relevant to the minerals and metals industry, given the very capital invested nature of the industry. Another long-term trend, volatility. I think that has been raised by a number of speakers. But there has been a lot of long-term volatility. One, when you're looking at just Canadian dollar versus US dollar. When you think 4 months ago, we were talking $1.05, now we're down at 96 cents. This makes it very difficult when you're trying to do planning for something that's going to happen in, say, 10 years with, a 4-year development period and maybe a 20-plus year life for a project. This makes it really, really difficult, so you've got to be aware of what's happening. Energy. What more can I say? Every time I go to fill up my car, I curse the energy companies. There's no easy solution. At one point, we thought it was nuclear. Well, then we see what has happened recently in Japan. You've got coal. Coal, perhaps clean coal technology should be cleaner. There's still issues with it from the point of view of greenhouse gas emissions. Oil and gas, again, greenhouse gas emissions. There's not a simple solution. And once again, this has particular relevance to mining, given that so many of our operations are sort of off-grid, particularly with new projects. So, what else can we say about volatility? On one hand, we've got the dollar, we've got oil, financial markets. We've had Enrons, we've had the subprime mortgage crisis in the States, U.S. debt ceiling crisis, which is going to keep going on unless Congress and the Senate can get their act together. Don't think that's going to happen anytime soon. Cross-listing of companies. You now have BHP Billiton, for instance, multi-listed. Before, if BHP Billiton had a problem, it took a hit on the Australian exchange, it would only hit Australia. Now, with all of this interrelationship, what we're finding is effects that happen in one exchange is carried right through the financial system. And you look at the most recent crisis, I mean, it started in the financial sector rather than a more traditional bit of an economic slowdown. So obviously, not surprising with all of this volatility, the issues of transparency, disclosure requirements, and obviously there's an increase in risk aversion. And that is going to be something that's going to take a long time to rebuild any level of confidence from the point of view of investors. So these are just a few of the things. So implications for minerals and metals on a global basis. China. Need we say more? The impact of China is amazing for the minerals and metals industry. This is basically China's share of global consumption of metals for 2010. Let's face it, the world is being driven by China, and from the point of view of the minerals and metals industry, when you're having those percentages, I mean, China is driving the industry. And there, it's a big change for China. If you look, again, back 20 years ago, China was exporting a lot of minerals and metals. Now they're becoming a net importer. Just to put this into another perspective, in 2010, China accounted for 41% of global demand for aluminum, while the United States, Western Europe, and Japan only represented 31%. So, I mean, what we've got is China is eclipsing those developed economies that we traditionally know. Obviously, the increase in demand we've seen has led to increases in prices. What this is a price index in which what we've taken is basically the price of copper, lead, molybdenum, nickel, and zinc, created a currency basket, and weighted it by Canadian production. So this is how we've created the index. And this goes back to 1957, and what you see is the dark blue line is nominal prices. So while nominal prices, have gone up, and everyone talks about, high historical prices, the problem is the turquoise line is real price. This is taking into account inflation. And what we've seen is basically, if you run a trend line through the real prices, it's basically flat. I mean, what we've seen are real prices have stayed more or less constant for the last 60 years. Then you wonder why we have some shortages of supply. It's not surprising because here you have a case of growing demand has been met to a certain extent by technology. I mean, we've had breakthroughs like SXEW, production for copper, etc. The problem is, how long can we keep supplying the world with base metals when real prices are flat? that is a major issue because we've all seen people talking about prices, costs increasing, but in real terms, the prices have not increased. And to put it into a bit of a Canadian context, if you're looking at Canadian reserves of base metals, if you look at from 1980 to 2009, our reserves for copper are 40% what they were in 1980. Nickel is at a level of 39% of what it was. Molybdenum is down to 15%. No, I'm sorry, I've misread that. 44% for copper, 40% for nickel, 39% for molybdenum, 15% for zinc, and we're down to 5% of the level of reserves for lead. And I mean, this is a function of real prices being flat. Over to gold. This one, we've done a mixture of gold and silver, and what you see is that, again, nominal prices obviously have gone up dramatically, but at least with gold, we've actually seen a real price increase. So that when you run a trend line through the bottom pure yellow line, you actually do get real price increases. And to a certain extent, one can see that when you figure that about 50% of all global exploration is directed at gold versus the base metals is sitting at, based on Metals Economics Group, numbers of about 38% for base metals. And let's face it, that comes down to the economics. Gold, you've had real appreciation, and normally you're looking at lower capital costs, lower infrastructure issues, so you can get your money back much quicker. So these are some of these underlying forces that one has to consider. Another set of things that have resulted from higher nominal prices. Mergers and acquisitions have gone haywire. Between 2000 and 2010, the value of mergers and acquisitions within the mining industry globally was sitting at $987 billion. Basically, everybody is buying everybody else. And obviously, I mean, there's a number of different reasons why people are purchasing. Some of the mergers are a function of product diversification, our product diversification. You look at Vale's role for buying Inco was basically to have a nickel operation. When you look at BHP's attempt to go after Potash Corp, it was to get a potash industry. So we were seeing a lot more investment. And with that, I've got sort of the world's largest mining companies based on market cap. I mean, that list will change every day. But the interesting thing is you look at the top three, the big ones, and then you look at the gap when you look at between Rio Tinto at 143 and the next one, Anglo America, is 69. So what you're seeing is this top tier of three super companies that are totally integrated and are looking at becoming increasingly diversified. Now, obviously, there's some level of acquisition that has always been in the industry. I mean, that's the whole reason for being a junior company. I mean, you find a deposit, you prove it up, and you sell it. But what we are seeing is acquisitions that are above and beyond those. As I say, it wasn't just a case of the Xstrata, Falcon Bridge, Vale, Inco. You've got Barrick buying Placer as well. You have companies that are making the decision that it's easier simply to buy another company to replace production capacity. We're also seeing new producers emerging. You have people like Mongolia, Zambia, Kazakhstan. Who would have thought 20 years ago that Kazakhstan would be the world's largest producer of uranium? They have now superseded Canada. So again, what we're seeing is new producers. A lot of these projects were known 30, 40 years ago, but the investment climate in those countries were not amenable to investment. So what you saw was a liberalization, and then at the same time, what we're now seeing, I'll sort of jump actually one down to rent distribution, is that you had this liberalization, you then get the production, you now get high nominal prices, and what do you get? Resource nationalism. One of the big debates has been around the issues of royalties. And that's basically a question of, is the government or the people getting the appropriate share of the rents generated by the resource? Now, the interesting thing, other than a little bit of a debate in Quebec, we haven't seen the same level of debate in Canada, and that's a function of our tax system. The interesting thing is Canada is one of the few jurisdictions that actually has a profit-based royalty system. So from the point of view of the government, and here I'll put my official government cap on, when prices go up, basically that means your profits are higher, which means, quite frankly, if you're working with a profit-based royalty regime, the government automatically gets a bigger share. So we really don't care whether prices go up or down. I mean, we are getting our pound of flesh out of you. In most other jurisdictions, Alaska also has a profit base, but most other jurisdictions are working on an ad valorem-based royalty regime. So the result is that their take is set basically on a tonnage or ounce basis. So when you get prices going up, the government, the only way they can increase the amount they're going to take is you actually have to pass legislation to change the rate. Hence that whole debate over what is the right level. We've avoided that simply because we've gone profit-based, and what you're seeing is a number of jurisdictions are moving towards that. The problem there is that if you start with a profit-based royalty, you have to have the capacity within the country to actually manage it. And that is one of the areas when you're looking at countries like Zambia, Mongolia, they may not have the administrative capacity to actually handle a profit-based regime, where if you're just doing it on the basis of you've produced X number of tons, here's the bill, that's a lot easier. The other bit is with Canada is that the royalties represent just a very small portion of the revenue that the government generates. And so from the point of view of the government of Canada, variation is not going to kill us. But if the problem is if the copper represents, say, 50% of your GDP, fluctuation is really going to have an impact on government coffers. So the whole issue of resource nationalism is an issue. It can take many forms. It hasn't just been a case of royalties. We've seen issues in Ecuador. You look at if you looked at the Globe and Mail today, as the Mongolian government has approached Ivanhoe and Rio Tinto to renegotiate the contract, with the result of the government getting a larger share. So this is going to be another play that's going to go on for a while, is resource nationalism. We talked about price volatility. Another issue is that even some of the old traditional pricing mechanisms are starting to break down. Well, people don't think about it, but I mean, for years, the price for coal and iron ore was based on an annual price. Pretty freaky that they've actually now gone to a quarterly price, reflecting the fact that the level of volatility. Well, I mean, if you're a base metal producer, this doesn't seem dramatic, but if you're an iron ore and coal, it represents a significant change. So again, we're seeing the volatility, the higher prices, we're seeing changes in the pricing mechanism. Actually, have I covered everything I wanted to on that? Oh yes, I guess I'll go back one. For the resource nationalism, what you're also seeing is don't want to point fingers at any particular country, but we'll talk about rare earths. You're also seeing a strategy that certain countries are taking in which basically, if you want the rare earths, you're going to have to move the manufacturing facility into our country. So again, this is other ways where you're seeing that resource nationalism being tied to an economic policy. We're probably going to see more of that. On to the next slide. As I've said, there's been a lot of increases in resource or in new emerging economies, economic growth. So what we're seeing is a lot of issues around security of supply. And I want to stress that this is not scarcity, but security. Because, I mean, basically, we've got the resources in the ground. The question is going to be, at what price will it cost you, and what's the lead time required? But what we are seeing is a lot more investment being done based on security of supply. You are seeing both Europe, you're seeing the United States, Germany, Japan, a lot of countries going out with a rare earth policy, or they're referring to it as strategic or critical commodities. You're seeing state-owned enterprises like JOGMEC or Corez, all of them looking at trying to basically find and secure raw material for their manufacturing. So here it's not a question of supply, but it's security of supply. This is just changing things, obviously. This chart on the side I thought was rather interesting. It was just recently released by the British Geological Survey. And what they did is they looked at 52 different elements, and they ranked the risks based on the evaluation of supply risk based on abundance in the earth crust, location of the current production and reserves, and the political stability of those locations. I thought it was interesting. I should have done the collection at the bottom was with a ranking of 4 is your zinc, nickel, sodium, uranium, to give you sort of a base case. Rare earths, of which everyone, you can't read a newspaper now without seeing rare earths somewhere, is being ranked at 8. But you look at some of the other ones, tungsten, 8.5, mercury, 8.5, platinum group metals, 8.5, antimony. And you look at who's the controlling interest. This is why there's the issues of security of supply. Okay, implications for Canada. $1 million question. It's going to differ for every part of the Canadian economy with respect to minerals and metals. A lot of people think of mining as just that extraction, but you have to recognize that it is more than just extraction. You've got exploration, you've got the smelting, refining, semi-fabricated and fabricated metal products all tied together. Into that, you've got all of the mining-related services, the hatches, the SNC Lavalins, the TSX. One also shouldn't leave out marine and rail transportation. Roughly speaking, 50% of the value of the revenue generated by the railroads and shipping companies come from the moving of minerals and metals products. So very integrated into the economy. Okay, quick look from the point of view of exploration companies. Traditionally, Canada has basically covered between 30 and 40% of the global exploration. This is data out of Metals Economics Group. The dip in 2009 is pretty obvious when you look at the red line. Obviously that's a function that Canadian exploration companies rely on the equity markets to raise money, where most other jurisdictions, exploration is done through cash flow. So, that's where you get that dip down. What you're seeing, I think, is that the exploration company or the Canadian exploration companies will continue to prosper, but obviously it is getting a far more complex environment. The issue of social license to operate, social responsibility, corporate social responsibility, all of these factors are, what was in many cases at one point just with mining companies, it's moving down so that you've got to do consultations early on. So this is obviously going to have an impact on the industry that they are going to have to be aware of the environment they're going into. And I guess just on a side note, we're looking at basically 55% of all exploration in Canada is carried out by juniors. So they are responsible for the lion's share. In some cases, you're almost seeing in Canada an outsourcing of exploration to the juniors, where the seniors will do on-site exploration around a mine to keep it going, and they will let the juniors do the high-risk grassroots. Obviously, financing will always be an issue, and the fact that the financial crisis hit the equity markets has made it harder for the juniors to raise money. What we're seeing is that, at least in June and July, with the increase in uncertainty, you have seen a decrease in flow-through shares being raised by the industry over the last 2 to 3 months. So obviously the issue of aversion to risk is alive and well. This one looks at Canadian mining assets abroad. Basically what we do is we look at the annual reports of Canadian companies, go through them, and identify property, plant, and equipment, and deferred exploration or amortized exploration. And we then plot it around the world. And what you see is Canadian companies are literally everywhere. So this exposure means, again, that they are going to have to deal with all of the international issues, the political issues, social license to operate, Aboriginal engagement, et cetera, et cetera. So, it is going to be a challenging environment. However, it is perhaps opportunities for feed for Canadian operations. Next, basically showing that Canada remains a very competitive investment climate. We have consistently ranked as the top destination for exploration since 2002. Which then brings us over to the issue of foreign investment into the industry, of which we've heard an awful lot of discussion about it. Canada has actually been very, very successful in attracting foreign investment. The Australians have, in absolute terms, have actually managed to attract more than Canada. It's just when you then equate it to relative to the size of the mining industry that we seem to be faring better than them, because Canada's mining industry represents less than 1% of GDP. In Australia, the mining industry is 8.9% of GDP. So we have seen a lot of investment inflow. And given the capital-intensive nature of the industry, we need the capital. And this is particularly when you're looking at the north. 3 minutes? I can do it. Basically, here it's a listing of some of the environment or some of the major projects that are going on. Bottom line here is that most of these projects, and in fact most non-gold projects in Canada, have foreign money in it. If it wasn't for foreign equity and capital, a lot of these projects wouldn't be happening. Smelters and refineries, they're having a tough go of it. Problem there is most of our smelters and refineries are just poorly located. Let's face it, Flin Flon was in the middle of nowhere. You've had the closure of Kidd Creek. The Horn has a niche market, but I mean, we do suffer from the location, and the issue of location is that we were initially created our smelters and refineries near existing ore bodies. Now what we're trying to do is compete with ones that are on tidal water. Makes it very, very difficult for Canada to compete. The one area where we do have a competitive advantage would be with aluminum, but even that isn't coming under competitive pressure from capacity being brought in the Middle East, where there is a lot of cheap natural gas. Equipment and service suppliers. Traditionally, and this is where the investment flows have resulted in a rather weird development, Canadian mining companies now own more mines outside of Canada than they do inside Canada. So the traditional relationships between Canadian miners and Canadian equipment and service suppliers has been broken. You have companies like First Quantum, lots of operations in Zambia, have never had an operating mine in Canada. They don't know the Canadian suppliers. Similarly, you have a case now, you have companies like Vale, Xstrata, they're looking for a world product mandate. Can that small Canadian supplier literally supply all of Vale or Xstrata's needs for commodity X? So this is an area where the suppliers have taken a bit of a beating because it is a very new environment for them. They're going to have to try to reestablish those links. Going down the value chain or up. This is looking at revealed comparative advantage, which is, from an economic point of view, is looking at how competitive you are. The basic idea is if Canada has, say, represented 10% of the world's trade, then if you have product X, if Canada's portion of the total export of that product is greater than 10%, then you're doing sort of better than the national average, which means that you're probably very competitive, and that if you're under that, then you're probably not as competitive. So what we did is we did the calculations for a number of the number of products down the copper value chain, and what you've got basically is as you go into semi-fabricated and fabricated products, we become less competitive. Now, part of the function here is that the reason why we're less competitive is that we as Canadians don't throw as much capital at it. So when you look at value added per job in mining, and I've got employment, is basically because both mining and smelting and refining are very, very capital intensive, you actually have a lot more value added per job. The only problem is as you move down, is that while the value added per jobs is lower, you have more people employed. So there's the policy debate for government. Do you want high-paying jobs, or do you just want lots of jobs? not a simple solution. And from the point of view of areas hit, when you think that since 2000, semi-fabricated and fabricated employment has gone from 273,000 down to 210. So they've lost 63,000 jobs, which in fact is more than the total number of people employed in mining, which is 55,000. So they have really felt the hit of the trends. And a final couple of comments. I won't read this, but basically down the list. But what we've got as well, the recession has had a significant impact, and one can learn from a lot of what was done or was not done right. The problem is, though, is that the recession may either have exacerbated or halted certain long-term trends. And what one has to really do is look at some of these really long-term trends and then position yourself ahead of those trends. And that's, I think, all I can say, since I think I've probably run out of time. So there you are. Thank you very much. And any questions?
Any questions for James?
Yes. Very interesting talk. And I don't know much about this area, so please excuse me. It's a silly question. But your second slide showed the Canadian dollar versus the US dollar.
Yeah.
That was the top line. And the bottom line
Was Western Texas Intermediate price of oil.
Yeah. And we hear it on the radio and that sort of thing, TV, that the Canadian dollar will drop in value against the US dollar when the price of oil goes up. But you're showing there that the trend is both upwards.
We tend to actually, because Canadian exports are we export a lot of oil. A lot of people equate the Canadian dollar to a petrol currency, so that when there tends to be a linking between the price of oil and the value of the Canadian dollar. Having said that, you also then have, at the political level, issues within the United States over our dirty oil sands, which then calls into question whether we'll be able to export that oil. So that there's a lot of things playing there.
Yeah.
And then you've also got the issue of, as there is increasing political turmoil in the world, a lot of people will tend to go towards the US dollar. So while you may have oil prices going up, which is seen as turmoil, you may still have people flocking to the US dollar, seen as still haven, which then puts the opposite pressure on the Canadian dollar. Exactly. So it's really, you've got a number of different forces playing, and on any given day, one force will beat out the other. But the end result is volatility.
Yeah.
I mean, which is why you've seen the Canadian dollar go from 105 to 96 cents over a period of 4 months.
Exactly. Yeah. And we were doing very nicely when it was at 60 cents to the US
Absolutely,
dollar.
and I mean that's what's really hammered the semi-fabricated and the fabricated people. You've seen the nominal price of copper, so their inputs have gone up, and then at the same time, they can't raise their prices. I mean, they're trying to sell into an international market, and you're trying to outbeat the Chinese. Well, you were having problems at 67 cents beating the Chinese, so what hope do you have when you're sitting at $1 or $1.05?
Yeah. And, yeah.
Just one observation I wanted to make was with Canada and Australia, I've seen that analysis done, so it's wonderful. And these are in sort of like the real metals like nickel, copper, cobalt. But what I'm seeing now is that in this periodic table of metals, there's things like rare earths, as an example, and then there's gallium, vanadium, uranium, and now selenium and fluorine and so on. And so what's happening is that this is all going to China.
It had been gone to China. I mean, what you had is that, in the sense of rare earths, the United States, back in the 60s, 70s, and 80s, actually produced rare earths.
So, but what I'm saying is, I don't see this trend reversing. So what I'm visualizing, yes, we'll have rare earths possibly here, but all these minor elements, these high electronic requirements and so on. So to me, there has to be something done, to have some of the industries, start having those sources of supply, because there's no way we're going to have the other downstream industries without having rhodium, gallium, indium, uranium, and so on and so forth. And I don't see us getting it.
Well, at this point, I mean, the question is whether or not, at this point, we import all of the products that have the rare earths in it. Just taking rare earths as an example. We do not have any rare earth production capability to refine it or produce it. I mean, we've got a number of operations that may come on by 2013, 2014. You've got the Australians do produce rare earths. The U.S. has the capacity. What you're seeing is the Americans and the Australians are looking at trying to secure that supply outside of China. Whether we will have the ability to create a refining or a magnet industry in Canada is another issue. In some cases, it's an issue of proprietary technology when it comes to the refining and processing of some of the metals there. But there's not much, from the point of view of the government of Canada, it's we don't mine and we don't do manufacturing, so it really is up to the private sector to make the move. And unfortunately, what you've got, as is fairly obvious right now, is that the private sector takes a very short-term view. When it came to the rare earths, is that they were quite happy to pay the lowest possible price they could to the Chinese, which basically wiped out the domestic industry in both Australia and the United States. And then all of a sudden, when the Chinese decided to start restricting the flow and demanding that if you want basically access to our rare earths, you're going to have to put the manufacturing facilities in it. That's when you saw people waking up. I know we've had discussions with some of the automakers who use a lot of rare earths, particularly for any of the hybrid cars. None of them have had any thought of getting into mining or trying to secure, put money into securing a supply. So they're quite willing at this point to let the markets decide what price they will pay for it, rather than trying to do some sort of vertical integration. And this is where you've got sort of China Inc. looking at things from a much longer term and that integration.
Comment further on that. So China will attempt, in all these minor elements, to control, get, and build up the industries to be able to process as well as use, and will then be able to develop all the industry downstream.
Absolutely, yeah.
Having them. And so that's where the rest of the world is not really, working on a market-based system. And subsequently, all of a sudden, we'll wake up and find out we can't get supply of some of these materials because they're being used in.
Absolutely. The Japanese have woken up to that, and that's why they're panicking, and that's why you see JOGMEC putting money into trying to find projects. They've invested money into Canadian projects. The Korean Resources Corporation is doing the same thing for Korea. People are starting to wake up, but it may very well be too late, at least in the short term. In the long term, as I say, the commodities are there, and it's just a question of what cost do you want to pay. And there's always going to be some sort of a lag. Any other questions?
Just a comment about the magnesium industry. That was completely wiped out in the West, right?
Yeah.
Same thing.
Tungsten was another one they did it to. Tungsten, they did the same thing. The Chinese have done it on a number of commodities.
Now, is that malevolent, or are they operating just on China Inc., or what do you see the future from China's point of view with its policy?
I think there is, they have stated with respect to the rare earths that their desire is to become the leading supplier and manufacturer of clean energy technology. So there, I mean, you're looking at a very conscious decision. They've made that policy statement. Now, with some of the other one, with the magnesium, with tungsten, I'm not sure whether that was, you know, a deliberate action or whether that was just simply in order to expand their export markets, because as people have noted, is that the Chinese have to keep growing to keep their population employed so that you don't have civil unrest. I mean, that's the last thing that the Chinese government wants, is a whole bunch of unemployed males. I mean, let's face it, I mean, you know, you are seeing a disruption in the ratio of men to female because of that now, what, 30-odd years worth of one-child policy and the tendency for them to get rid of the female baby. So, quite frankly, as a government, I'd be pretty worried about a couple of million unemployed males that don't have any women to try to control them. Don't tell my wife I said that, please.
Any other question, comment? If not, then let's thank James Lauer for very good. That concludes our symposium. Thank you very much for attending.